Um, Definitely feels more like a couple years ago than it did last year in terms of listing activity, especially in like that, what I would say like the under 600 range. Um, I've listed a couple investment properties in the last couple weeks, and those have been very busy with inquiries. And so, again, I think those buyers tend to be a little bit more rate sensitive, but as we'll get into here in a second, rates did spike and now they seem to be like slowly trending down, which is usually the way everything goes. It goes up quickly and then takes a while to get back. So all right, cool. Well, we'll jump into the numbers and then please, as always, thank you to those of you that are here for the first time. I think a lot of you have been here before, but please don't hesitate to interrupt. If there's something that you want to say or a comment, definitely don't need to be the only one talking here. So just feel free to put it in the chat or interrupt. If you see something really good in the chat and I don't catch it, please feel free to jump in. Really quickly about myself, I've been an agent here in Columbus since 2004. I'm an investor. I also have a property management company. I do some real estate coaching as well. And so, yeah, definitely feel free to follow me. What we'll go over today is how to become the local economist of choice. We're going to talk about interest rates, consumer confidence, inventory and selling trends. So that'll be kind of on the national level. And then if you guys that aren't from Columbus want to jump off, I totally understand. But if you're interested, we have kind of a little bit more granular data for the Central Ohio market that we can get from local places or local sources. And we will also at the end talk a little bit about mortgage application trends. Maybe actually next month, maybe I'll move that to the first section. So if we've got people from New Orleans jumping on, we can jump into that. And then just briefly touch on kind of what rental trends look like. All right, so whenever we talk about all this stuff, if you're a numbers person, you're probably going to geek out on all of it. You're going to memorize half of it. You're going to email me for the slides, which you can do at troy@marshhomegroup.com, and we can get those to you. Also, this video will be up on YouTube. Usually Heather has it up like within 24 hours, but definitely by next Monday. But ultimately, for those of you that aren't numbers people, a lot of you probably fall into that group. My encouragement is always just pick one or two things that you can know really well and crush those things when you're at the kitchen table. Ultimately, the average consumer doesn't really know 99% of this stuff. And so if you can just be a source of information that makes sense, that helps them make a more informed decision, I think it really puts you at the head of the pack. If you're a newer agent, and you don't have your experience and your past sales to fall back on, I think having this information, especially in a time like now, can really be the difference between you closing a deal and losing it to a more experienced agent. Because ultimately, regardless of what price range people are looking in, regardless of what political affiliation or how they feel about what's going on from that perspective, I think I listen to CNBC every morning like a good nerd would. And I think even when you listen to the most experienced economists, which are way smarter and know way more than I do, the common thread is that no one knows what's going to happen a month from now or a week from now, let alone a year from now. And so whenever you get into these types of very uncertain environments, really people fall back on emotion. And so the more you can lower the temperature during a conversation, the stronger you are. And so if you know something really, really well, and you can equate it to how it helps a seller or a buyer make a sound, logical decision instead of an emotional one during a very emotional time, I think that it really bodes well for you and your opportunity to earn business. There aren't very many things that we have to look at every day, multiple times, like gas prices, to remind us that things are changing. Even when grocery bills go up, it's like usually once a week that you have to look at it. Now, on your way home or to an appointment, you're going to see 10 reminders of the fact that gas is $1 more now than it was a month ago. And so it just creates uneasiness. And so I think our job as agents is to really just bring down the emotional temperature in what already is an emotional experience for most people. So, anyways, took a little bit longer than maybe normal on that, but I think it's a really good point. Don't feel like you have to know everything. Um, because all this stuff is emotional for all of us to a degree as well. So, all right, interest rates. I literally just updated this chart here within the last 30 minutes. Mortgage News Daily came out, and rates are down again today, another 7/10, or I'm sorry, 7 basis points, so 7/100ths of a percent. Obviously, not a big difference in the grand scheme of things, but the trend for 2 days in a row has been back down, which is good because we had a very bad end to last week. So you can see we were on a really good trend down, other than a couple days for a couple pieces of financial information. But for the most part, we were trending down. I don't think anyone in the country didn't hear that a couple weeks ago rates went below 6. Unfortunately, that lasted for about a weekend and then bumped back up. They kind of bumped around a little bit last week, and then starting, I think on Wednesday or Thursday, they jumped really high. And almost all of this has to do with the increase in the price of oil. Why does that matter? So I don't have a slide for this, but if you want to sound smart to your consumer, I think this is a really good point to understand. So the reason why interest rates went up at the end of last week is because with the rise in oil prices, the bond traders, which control the rise and fall of the 30-year fixed, believe that that increases the chances of inflation over the next year. And higher inflation means that the Fed is less likely to lower rates. And that's the reason why rates went up. So if you want interest rates to come down, you're hoping that the price of oil is going to come down. With the lowered price of oil, every single good in our country and really across the world for the most parts gets transported by something that uses oil. So when it costs more to transport something from the port or the field or wherever to the grocery store or Meyer, or wherever you're buying something from, Best Buy, whenever that trip from the warehouse to your front door, if you're Amazon, that vehicle needs gas for the most part. And that gas, when it's $1 or $2 more a gallon, they're going to pass that cost along to the consumer. So I think this morning, I don't have these in our slides, but I think on CNBC, the average economist thinks that the consumer price index, which is the gauge of inflation, will probably go up about 0.2% higher than last year, and it's been on a downward trend if the oil prices stay elevated. So that's the reason why interest rates went up. The reason why interest rates are going down this week is because a couple ships have made it through the Strait of Hormuz, which is near Iran, without getting hit by drones or bombs. And so because of that, the traders feel better, and oil prices have stayed below $100 a barrel, right around $100 a barrel. I'll say it can get very complicated, but right around that, which they had been last weekend or a few days ago, as high as 120 a barrel for a very short time, but just a little bit more movement in the oil market. So keep an eye on oil prices if you want to know what rates are going to do in the very short term. All right, consumer confidence. Obviously, the war, conflict, whatever you want to call it, has only been going on for a little over 2 weeks. But the University of Michigan every month does a study does a survey of consumers. And so they did capture a little bit of March already. But basically the consumer expectations and sentiment has already started to reflect that. People are feeling month over month still like things are a little bit better, but their outlook for the future is negative compared to last month. So again, I don't know how much of this is captured by the war conversation, but definitely I think you're starting to see some of it creep in as you would expect. Um, the uncertainty in everything does not help consumer confidence. So I'm going to kind of gloss over this a little bit this month. I will say for those of you that haven't been here before, one of the things that I've really started to dial in on these conversations each month is more about the consumer confidence, because what I've seen over the last few years is that although consumer confidence tends to trend in some ways with interest rates, actually the number of mortgage applications and different things like that tend to trend more in line with the consumer confidence level than they do even with interest rates. And so that's why I've started bringing this in, but I think not much from the last couple weeks is going to be captured in this data, so I don't think it's as important as normal. But this part does. So this is the difference between mid-February to the end of February, and then basically I think the first bombing was on the 28th. So basically starting on March 1st. So I always have to laugh at the fact that they ask consumers what the prices are going to be 5 years from now, as if they have any clue on number one, how to logically determine that. And number two, whether anybody knows what the gas prices are going to be 5 years from now. But they ask the question, and the average consumer believes that gas prices are going to go up a lot. Actually, they believe that they're going to go up a lot in the next 1 year. And they're saying like up to 40 cents more in the next year versus at the end of February, they only thought it would go up 10 cents. And when it comes to inflation, again, uh, oddly, they haven't really anticipated. I mean, what is that? Like, it doesn't say exactly what that difference is, but it looks like about 1/4%, which, to be honest, is a relatively small amount. So that's interesting. I think if you saw the headlines and listened to the politicians, the consumer and the politicians might not be on the same page. But either way, the long and short of it is that everybody believes things are going to become more expensive. Now, this is all consumer, relatively uneducated on the topic opinions, but consumers behave based on their opinions and their emotions around those opinions. So it doesn't really matter why or whether it's warranted, they do. And so that's that. All right. Active listings. This is the real estate national numbers. Active listings are pretty flat month over month, but they're up year over year by 7.9%. If we look, this is interesting information. February remains 17% below pre-pandemic norms. So even though we all feel like there's more listings out there, there are more listings out there nationally for sure. I think locally there are also, but it feels tighter, I think. But it's still about 17% below pre-pandemic. So that's an interesting thing to keep your eye on. New listings are plus 2.4% year over year. Again, I I feel like, and this is a time where I would love to get your input, but I feel like we were thinking that this spring was going to have a lot more new listings than what we've really seen. I think everybody was kind of expecting that we would kind of continue on that trend that we were seeing last year, where we were getting a bunch of new listings, and it doesn't seem like that's necessarily the case. 15.2% below pre-pandemic norms, so in line. Is anybody else feeling like there's fewer new listings than you expected, or it's just still low and that's what you expected?
I don't know. I thought there would be, this is Jenny, thought there would be more listings. But I am seeing a lot more people talking about it. But in all, you know, defense here, I'm focusing more on listings personally where I just always had buyers kind of falling in my lap, so I'm focusing more on that. But I do think that what you're talking about is I think there's a lot of penned up people that want to list. And I think that with everything going on a global scale, my sense is that we might not be hearing from everybody that's interested because they feel stuck or they feel scared of doing it because they don't, maybe there's some domino that's being impacted by them listing it by what's going on a global or even mentally or emotionally.
Yeah. I definitely think that's some of it. I think too, the quick, which just doesn't have to do with the new listings, but when we talk about Columbus as a unique market, the quick turn from like the frozen tundra to like 65 degrees, the buyers come out immediately and the sellers, I always tell people the sellers start thinking about it as soon as the buyers start writing offers. And so really like this time of year tends to, I always tell sellers when they call me early that this is literally March, like early March to early April is the best time of the year to list because you have the most buyers in the market because usually it starts warming up and you have the least amount of competition. Um, I would be curious though on your point because I think what you said is that valid. Like even how many has anybody had any seller call them and delay listing like you had talked about listing in early to mid March and because of everything that's going on they're pushing it to April just to see what happens?
Mm-mm. No.
No. Well, that's good news,
Yeah,
I
that is good
guess.
news.
Hey,
I don't,
Troy.
well, I don't know if it's good news. How many people have a lot coming up in the next 4 to 6 weeks?
I do.
And is it just a timing thing, like wanting to be, um, like work the school schedule, or what's causing them to decide for mid-April or sometime in April versus now?
Yeah, I think with mine, it's just a timing thing for everyone. I mean, I started getting pictures for some of these listings in the fall before winter came, and now they're coming on the market. So it's just what their timing preference has been. And and I'm glad they're spacing them out a little bit. So yeah, no one has said anything to me about not listing or pushing
Cool.
it out any further because of
Of
anything,
anything.
actually.
Okay, cool.
Hey, Troy, when do you think, just I can't even remember when the low interest rates and we'll say the 3% range, was that 4 years ago when it started or
Yeah, it ended in like this time in 2022.
it ended?
It ended. So yes, rates started going up like January, February, but they probably in 2022 right now, they were probably at like five.
Yeah, so when you think of that period that which was a pretty sustained period around that 3% mark, at what point do those things start somehow factoring in those that group of people that bought at that interest rate that typically might be getting out of that in a 3 or 4 or 5 year time frame now or more for do you think there's a huge pool of people that are kind of in that situation? We know
Yeah,
there's
I
a
think the number I heard this morning on CNBC was nationally still 80% of mortgage rates are below 6%.
So it's going to be interesting to see just as you start to evaluate from a comparative standpoint, because
Right.
that's a big chunk of, new listings that maybe historically on a trend line would have shown up that somehow gets delayed. I don't know how,
Oh,
but
100%. I mean, that's certainly been a problem, I think, across the board. And I think that in combination with, since rates went up, also the builders supply, the builders have built, but not, certainly not at the rates they were building before. And I think everybody, builders, definitely the ones that are around now for the most part lived through 2008. And I think that's fresher in their memory than it is the average consumer of what it was like to be stuck holding the bag with a bunch of inventory when the market slowed. And so the builders have been reluctant to put, I mean, I don't know about you guys, but I have a lot more people who are going towards new builds. But there's not, I mean, although they have inventory available, there's not like a crazy amount of inventory. And so it's just the inventory added versus the number of transactions needed. The other thing that got mentioned this morning, ironically enough, everybody knows the Property Brothers from like HGTV or whatever channel they're on. They were on CNBC this morning. And so this was like a conversation about the housing market because there's also a bill that's going through Congress that if it passes, I'll talk about next month. But that's, I think, going to be a good thing overall, if and when it ever passes. But they were talking about the fact that investors also, and I mean, I'm one of them, like I own quite a few single family houses that in a perfect world, honestly, I would be selling and moving into like a multifamily type of situation. But because of the interest rates I have on those single families versus the interest rate I would have on a variable, commercial loan, I'm more comfortable just sitting on those. And those would probably go to the market to an owner occupant if I listed them. So how many investors are out there holding on to rental properties that would cash out if there was an opportunity to move into something else at a similar interest rate, So that's another locked up piece of inventory. All right, pendings year over year. Again, we saw actually our first time since what was it, like fall of 24, that we've had 2 months in a row of increased pendings year over year. So that's definitely a good sign. 4.2% increase is one of the largest that we've seen since really 2021. So as you can see, if we would have been having these conversations back in 2022, we would have seen, look at, this is when the interest rates started going up, Francis.
Yeah, exactly.
Literally started here and then, yeah, just drop, drop, drop. Obviously, too, we were at historic sales levels here as the year before as well. But all right, median days on market over across the nation is up to 70 for the median days on market. For those of you that don't remember back to sixth grade or fifth grade math, the median means that half the houses are selling faster and half are taking longer. It's different than the average. I don't know. I have Allison in here. She was a fifth grade math teacher, sixth grade math teacher. So she might be able to give you the exact definition of average, um, but long story short, a lot of days. So outside of 2020 and then pre-pandemic, there's been no higher time, but still below pre-pandemic averages, which is interesting and kind of puts things into perspective. This is a new graph that obviously Realtor.com's had the data for a long time because it goes all the way back to pre-pandemic. But very interesting, the number of contract cancellations in a given month. So if you look at the pink line nationally, we are at the lowest levels since 2022. And actually below the trend line of even pre-pandemic of 2017 to 2019 in terms of the number of properties that are going into contract and then falling out of contract.
Is that a
So,
percentage, Troy? Is that like a percentage
yes.
or
So
okay.
7.4% of contracts nationally. And I'm assuming the way they track this is something moved from pending back into active status. Which it's kind of a cool graph, actually. Look at that. Even though like this looks so drastic, right? Even in March of 2020, during the pandemic, only 10.5% of contracts were falling out. And right now we have 7.4%. It looks like the historical average is between 7.5 and 8. So it's like even during the worst of times, like I don't know, for those of you that were in the market, I feel like if I would have asked you like what was this percentage, you probably would have said like 60. and it was 10.5. Only 3% higher than it was the month before, which is
It's
just wild.
it's interesting though because it seems like you see more things going back on the market
I
over the
know.
last six, like a lot more over the last
Yeah.
6 months,
Now let's
at
see
least
if
in
we
Central
go.
Ohio.
Yeah, if we go to 2025, which is the purple line, yeah, it was still at like almost the lowest it had been. Now, I think what we did feel last fall, if you're a listing agent, is like if we go back, look at like I guess in 20 and 21 it was lower, but even the last couple years like 22 and 23, if you fell out of contract, usually you had another buyer like waiting in the wings. Whereas here, like last fall, if you fell out of contract, it might be another month before you got another buyer, or another 2 months before you got another buyer, right? So I think that certainly changed last year. So, all right, median list price. This is something to keep an eye on for sure. I wouldn't say it's overall like surprising, but definitely something to keep an eye on. You can see the last 3 years we've been in a pretty tight range of average list price. And look at the February really is where the trend line really went, down essentially compared to the last 3 or 4 years. So it'll be interesting to see if that was just a blip in the radar or if that becomes something more of a trend. Share of listings with a price cut in February. I'm not sure, down 16.8% in February 2025. Hmm. Does PP mean percent as an abbreviation? Anybody know? Oh, pre-pandemic probably. I don't know. I'm a little bit confused by this number.
Yeah, I
Share of
know.
listings with a price cut. So 15.5%. Oh, it's 1.3% of pre-pandemic change, maybe. I don't know. I should have known more about this before I brought this on. Sorry, guys. I'll have that slide better prepared next time. There were some cool new graphs, and I thought that I had looked at all of them in detail, but obviously I missed that one. Um, all right, this is just the regional changes. So active listing count, year over year up 10%. We were one of the biggest ones. New listing count, the Midwest was the highest out of the whole nation in terms of new listings. Median list price, the Midwest was the only region that had a positive increase year over year in median list price. And I guess the West was minus 2 days on market, but that's because last year was so bad. And price reduced share, um, kind of all over the board. I would say in general, this slide, the regions are becoming less and less different, other than obviously the prices, the overall prices. But national average is still 403,000, but in the West, 580. Crazy. Northeast 500. All right, what's happening in Central Ohio? Um, I guess I'll stop there for a second. Does anybody who's not from Central Ohio have anything to add before I move on to Central Ohio? Are you guys good? Good, cool. All right. February over February for sale, number of active properties was up 13%, which was basically about 450 listings. The number of new listings in February was down year over year, which is very interesting, especially when pendings were up. Number of closed transactions was down 1%, which I was not anticipating. I thought February closed would have been up. So we'll see how things go uh, here this month. All right, if we dive even more granular into Dublin, whoops, I just trying to move these Zoom boxes around, which I know you guys can't see, but it's keeping me from being able to see. In Dublin, the number of available listings down 4.8%, but the new listings were up 12.3 year over year. Solds were up 46% year over year. So that's, I think Dublin had a lot of pendings last month in January, and then obviously a lot of those closed in February. And then the pendings are still way up year over year. So that's interesting that we might be seeing more movement in the suburbs than we are in the city overall. With Hilliard, right? This is Hilliard. Yeah, Hilliard down 8% in terms of active listings, new listings down 25%. That's going to be brutal on overall inventory as we move into this month for sure. Sold up 31%. And then the number in contract down, most likely just due to that's year over year, most likely just due to the lack of new listings. So really wild there. Olentangy has continued to be slower. I think maybe part of it is definitely due to new construction and the percentage that's new construction. But the number for sale, the inventory is finally dropping there, down 11%, new listings up 8, solds up 16, pendings up 28. So it looks like the inventory is probably going to continue to drop in Olentangy, maybe check up or
Hey,
catch up with
Troy,
Hilliard in Dublin. Yeah,
quick question. Are those numbers, do they include the new builds, like the inventory homes and things if they're in
they
the
do.
MLS? Okay,
Yeah.
thank you.
Haven't broken it out, but you guys anybody who's in our office has access to Trend Graphics, and you can go in and break it out based on new construction. So I would do that, and I should make a note for myself to do that next month because that would be interesting in these suburbs, especially. Um, to just see if that's the reason for the extra inventory. Because obviously Olentangy has a lot, but so does Dublin. And sometimes, but when we're talking about 27 homes being the difference in movement, sometimes that can matter. Here's the overall market, new construction versus resale. You do see though that new construction had 17% fewer new listings last month. Sold on the MLS were down, inventory was up, so probably a reason why new construction isn't building more houses since they're not selling as much. Average days on market locally is 46. Remember, the median, at least in nationally, was 70. So we're still sitting in a much better spot. And remember, too, these are based on sold properties. So I think that we'll probably see that days on market start trending back down again, just based on the activity I've seen in the market on our listings over the last couple weeks. But already the average sales price to original list price, so not the last thing it was listed at, but the original price it was listed at, ticked back up this month. Um, which the same thing happened last year. It actually went from 95 to 97. So that's right on pace with trend. But as you can see, I would expect that we will probably peak on price somewhere in the May to sometimes June timeframe. So just keep that in mind. As you're pricing, you might have a little bit of wiggle room this time of year compared to what you'll have once we get past that May time frame. Months of supply drop back down below 2 months. So remember, a balanced market is 4 to 6 months. I don't know if any of you guys had the pleasure of showing those couple listings. I know we had a couple buyers on our team looking in the Dublin, Worthington area, and I know there was one listing in Dublin last week that had 120 showings. And then I know one that one of my buyers was interested in. They went to the open house, and I think he said that they had like 60 scheduled showings and then had another 50 people through the open house or vice versa. So definitely vibes of 2021 at some of these listings. So it'll be interesting to see what happens. New construction, again, we saw kind of a spike. Very common though, if you look at last year. We didn't see quite the drop in February though, so we'll see if that trend continues there with new construction. And our average sales price was actually negative month over month, down about 0.3%. Last year in January, we saw a huge dip. I think it was a little bit artificial. And so then we did see an increase in February. I would anticipate to see an increase in March. If we don't see an increase in March, that will definitely be a red flag that we might have um, a flatter price year than we've had the last few. So we typically expect to see March, April, May, June, sometimes into July for the price peak. So we'll see what happens here. But we'll be looking for next month to see a pretty big increase. Still, even in spite of a low month, year over year, February was still up 4.7%. So if you want to talk about average appreciation, average annual appreciation, we're still in that 4 to 5% range if we look at last February to this February. All right, here's the showing data that we put together on the team. These are the total number of showings in the market. The dark purple line, we're going to have to start doing the realtor.com. We're getting enough years here that we'll have to do like the pre-2025 average or whatever. But last week and the week before were the first times since the beginning of the year that we popped back up. So since 2022, we've seen more showings happening in the last 2 weeks than we had in any of the previous 3 years. So that's good news. I think when we had seen this previously, it was largely due to just buyers looking at more properties per buyer and not necessarily an increase in showings per listing. But you can see after basically being below last year for most of this year, other than like this 1 week, we are now like in line with last year, which represents a pretty significant increase. But we haven't gotten back up to the 2024 mark. And a lot of that is just that we have more listings sitting on the market right now. So, and that's been a trend. So until we get that inventory lower, unfortunately, we don't have a or we have to see a huge increase in buyers. Now, the good news is, and I'm not sure why this is weird, but the good news is year over year change in purchase applications last week was up almost 11%. Now, refinance applications were up 81% because obviously there are a lot more eligible people for refinances than purchases. But still, this is what we've been feeling in the market over the last the last month with interest rates dropping. The number of purchase applications just last week were up 10.8%, but then the change week over week was up 7.8%. So that's definitely all good stuff. And here's what the last year looks like. If we zoom in a little bit further, you can kind of see the inverse relationship between when rates go down, the number of purchase refinances go up. And then when we look at refinances versus purchases, you can see we kind of saw a spike in the purchase interest in February, and then it's kind of slowed down, and then now it's speeding back up again, which is ironic because with everything going on. But I think this is due to, I bet this weekend was the one where rates went down to below 6, and every news story was like, oh my gosh, it's the first time that we've seen rates below 6 since 2022. I'm going to keep this in here until it's not relevant anymore. It's getting very old now. We have to go back to June of last year. But ultimately, because I haven't been able to find an updated one, but ultimately this is showing the number of buyers in the market compared to the number of sellers. And I still feel I think this gap is probably widened at the end of last year, but now it's shrinking back. And ultimately, what I believe is that as soon as we see rates come in and stay below 6%, whenever that is, we're going to see inventory dry up quickly. I think it's already started to happen based on the data in Central Ohio. And I wouldn't be surprised to see those numbers start to trickle through the whole US, although Central Ohio is definitely leading uh, is a is out in the front of the in the front pack of cities of larger cities in the U.S. So, last but not least, the rental market. I think overall we're moving into the good rental market time of year, late spring, early summer. But we have seen a little bit of softness in rents. And so that's something to keep an eye on if you're an investor, probably be a little bit more conservative with your rent estimates, especially on assets that you're buying. So that's all I've got. Anybody else have questions, concerns, comments, anything else that you want to chat about before we jump off?
I'd
Roy,
be
as far
curious.
as,
Oh, go ahead, Todd.
sorry, the supply, so we keep seeing it dip down 1.6 months and versus national. Do we ever see, like, in the next 2 years, Columbus, Ohio really building supply to where prices, I feel like we're in this low supply, high price, not high price, but increase in prices continuing.
I think that this if you guys haven't, and I'll bring the information. I'm writing these down. I'll bring the information next month no matter what. I would encourage you guys to go do a little bit of research. You should be able to just Google like this bill. The House and the Senate have now passed a version of it. Now they have to agree on a few changes. But I think they've passed like with like 10 dissenting votes in the House or something like that, which I don't think they agree on anything even close to that amount. So I'm expecting that sometime here in the next few months that'll pass. I think it'll help, but the big focus is around regulation. So it's just it's so hard to get anything built and developed because of all the different regulation. Like nobody wants to have an apartment complex in their backyard. Nobody wants to have high density, housing in their backyard. And so I do think that the city of Columbus has already, with some of their zoning changes, made some steps forward. Like they're going to be making it much easier to build ADUs. There's corridors where you can basically build, I think, up to 9 or 10 stories, maybe even 12 stories, like along Parsons Avenue, for example, without getting a variance now. So I do think there are some things happening in Columbus that have already been passed, and certainly some other things that are very far down the road of discussion that can help do that. I think, unfortunately, if you're a landlord, you will need to be keeping an eye on the fact that the Columbus City Council is trying to pass a law that says that you have to have your rental property, if it's in the city of Columbus, inspected every year by the city, which as a landlord sounds like a complete nightmare, but sometimes theoretically they could do that stuff in order to limit investment because they want to have more homes available for owner occupants. So I know this was a really long answer to your question, but I really don't see a huge impact in supply over the next 2 to 3 years. So my expectation would be that barring like a major economic decline or major recession, that we're going to continue to see prices tick up, on the higher end of that 3 to 5% range per year, which is well above the national average, as you saw. I think for the most part, the last 3 years nationally have been pretty flat. And Central Ohio's been really between like 5 and 8% annually. But because our average sales price is so much lower than other parts of the country, it still feels inexpensive here if you move here from another part of the country. I think the other thing that isn't going to help with this if it happens, would be if they really do something with property taxes. Because that's the one difference, like between here and Colorado, for example. Like it's I pay 1/6 of the property tax that I paid for the similar priced house in Colorado as I did here. But everything else is more expensive. So, I mean, you pay for it one way or the other. But when you look at housing, obviously that impacts what people feel like they can pay. What else? Somebody else was asking something when you asked that, Todd.
Me.
Stacy.
Yeah, I'm just curious of those listings that had 50 and 60 people through, was that was that agent like we in my mind I'm like I don't know what's going to happen. Anything can happen on your listing. Let's price it under market, hope to get multiple offers, or were they pricing it at market value? Because I'm doing my year over year appreciation on an upcoming listing that I've got coming up, and year over year at 4%. Is that what you guys are using now? I don't know. It comes in way lower than what I thought I was going to list it at. I'm
Yeah,
afraid on pricing actually right now.
yeah, I think you do have to be cognizant of overpricing. Both of those listings in particular were they were underpriced strategically. I mean,
Mhm.
one of them, the investor who owned the property, this is what I was told. They wanted to price it really low just to get rid of it. Um, and then the other one also was a flip, but they had strategically priced it kind of on the lower end in order to get a higher price. But they ended up getting like, it was a 370, I think, house, and they ended up getting over four with full appraisal gap, like the whole shebang.
Mm.
Um, so. Yeah, and I mean, I know I just put a listing on that had been on for 4 months last year and not sold, put it back on at the same price. It was on the market for 7 days. I had really good activity, but no offers. Like three or four people said they were very interested and I ended up writing on something else. And yesterday had called for highest and best on Sunday and had four offers at
Mm.
the same price that it sat on the market for 4 months last year.
Okay.
So, so yeah, I think I would say that definitely, be careful pricing off of October, November, December, maybe even January closed. Maybe you saw a 4% decline off of the baseline, so maybe you need to go up 8%, if that makes sense.
Say that again.
So like if we go back, let me share this really quick because I think it's easier just to look at this graph. If we go back to this, so if you look at what happens in a normal like year, you can see that pricing peaks in June almost every year. And these are based on closed sales, right? So this is a contract that gets written in May, closes in June. And then starting in July, it's usually like the downward trend, like to December, basically. Last year was a little bit of an anomaly. So I would say January usually is, I guess, the lowest. It's usually not this low. I think last year was an anomaly, um, but it's also not usually as flat as it's been this year. But basically, you can see that last June, the peak was 391, but in September, November, December, January, like houses were selling for $40,000 less. So like what's the percentage on that? I mean, that's almost 10%, right? Or it's
Hmm.
more than 10. No, it's almost 8%. What is that, Francis? You can do those things in your head. You're a CFO. What percent is that?
It's lower anyway.
Yeah, it's like 8%. So if you consider the fact that during the winter time, you're basically taking, in theory, an 8% haircut on price, but then now you're about to list in the highest time of the year. And you think that the highest time this year is going to be 4% above the highest time last year, then you might have a 12% difference in price, in theory. Um, but I would be very careful using those averages because there's a lot going on here. Like one thing that always happens in the summer is the most expensive houses list in the summer, right? Like it's not very often that you're going to see a $5 million house go on the market in December. So when we talk about the average price, you definitely have to take into account that it's not just the fact that it's not like the average $400,000 house. So just keep that in mind. But yeah, I think that certainly now you have a lot more room for error between now and May. I
Yeah,
think
when I did
starting
the
in May, at the end of May, beginning of June, that's when you need to be very, very careful again because you really don't have any time to adjust if you miss the market.
Yeah, when I did the year over year, that 4%, it came in 100,000 less than what the RPR shows it should be at right now. I was like, oh, okay,
Yeah,
100,000? That's not
yeah,
helpful.
100 grand is a lot. Um, but
And
again,
then,
you have to remember too, though, if you think of RPR as the same as a Zestimate, like, I mean, Zillow themselves will admit that sometimes their estimates off by as much as 20%. So if you're talking about a $500,000 house, 20% is 100 grand in either direction. So I just be very careful with those automated values because they're not usually off by 20%, especially if it's in like a neighborhood. But especially with rural properties or very unique properties, be very, very careful with those. Um, but I would definitely look at the sales that happen from October to January as your floor
okay.
for pricing. So what I mean
Yeah, the
by
only
that.
comp I could find was of this time, March last year is when it sold,
Okay. And how was that, like closer to what RPR said or closer to what you said?
closer to RPR.
Yeah. So, but that's what I'm saying. So I would price off of that. I would
Okay.
be more inclined to price off of that and maybe add a percent or two. But then I think you were the one, maybe it was at the beginning of this conversation. The other problem is if we underprice, what we're finding is in the market right now, we're seeing the buyer adjusting for that price. And we can use those couple examples I shared. The downside of overpricing is that you lose your chance at that first impression and you lose the chance potentially at the competitive situation. And
Yeah.
so I would argue that Mr. and Mrs. Seller, I would rather underprice your house and allow the market to get us to where the market is than overprice it and then have to deal with a potentially low appraisal. Because this time of year, you're always susceptible to a low appraisal because even though we know that last March might be a better comp than the November one, in the appraisal world, they just think the most recent comp is the most recent reflection of the market, which we definitely know is not true, but that's, the analytical world that they live in.
Okay.
Somebody asked about pre-appraisals. I mean, I don't think it's a bad idea. Again, I think the only downside is that appraisals don't take into account the fact that the market was slow, but it is something, especially if you're going to list right now, that you do have to be cognizant of and you will have to deal with because appraisals look backwards. Um, when you list in April, May, you usually have a couple sales that closed in March or April that you can lean on for like the market of the moment. But when you're going into contract, especially in February, but still a little bit in March, without an appraisal gap or waiver, you're definitely at the mercy of a December closing that was, 10 or 12% below where the market is right now, impacting what you can get. So if you don't have a waiver, so if you have a seller who's unrealistic on price, this is a perfect time of year to pay for a pre-listing appraisal because it's probably going to come in way lower, maybe even lower than what you said.
Okay. And then these slides we need to request from
Yeah, just email me at Troy at Marsh Home Group.
okay.
And Allison, I would be lying if I said I was the one that's going to send them to you, but Allison will take care of you. And then,
Okay.
like I said, the recording will be on YouTube if you guys want to share it with team members or anything like that. Should usually within 24 hours, but definitely by Monday.
Thank you.
All right, guys. Anybody else have last minute thoughts, questions? No? All right. Well, thanks to the 10 of you for being troopers. And I will see you guys next month.
See ya.
Right.
Bye.